No matter if you're working, studying, or scrolling your phone, this is important. One of the biggest market drops in years just happened, and most people don't understand why. People think markets fall because of bad news. They think a headline, a tweet, or a politician caused this. But markets don't crash because of news. They crash because something underneath the system breaks. This wasn't just a bad trading day. This was a major shock to the global financial system. Trillions of dollars were erased. Stocks dropped fast. Volatility exploded. And investors started asking the same question. Is this just a correction or something bigger? To understand this drop, we need to zoom out. For years, markets were supported by extremely easy money. After the 2008 financial crisis, central banks lowered interest rates to historic lows. After 2020, they printed trillions of dollars to stabilize the economy. Cheap money pushed investors into risk. Stocks, real estate, crypto, private companies, everything surged. But cheap money doesn't last forever. When inflation returned, central banks raised interest rates. In the United States, inflation hit levels not seen in decades, so policymakers had to tighten financial conditions. Interest rates are like gravity. When they rise, asset prices fall. Future profits are worth less. Debt becomes expensive. Risk becomes dangerous. And the global economy was built on debt. Companies borrowed aggressively. Governments accumulated massive deficits. Consumers took on mortgages, car loans, and credit card debt. When rates rose, the system felt stress. Investors realized something important. Many companies and markets were priced for a world that no longer exists. So they sold. But humans weren't the main sellers. Today, algorithms and automated trading systems dominate markets. They react instantly to price levels, volatility, and liquidity signals. When certain thresholds break, machines sell automatically. This creates chain reactions. Prices fall. Algorithms sell more. Leverage unwinds. Liquidity disappears. This is how small drops become major crashes. History shows this pattern clearly. In 1929, margin loans amplified the Great Depression. In 1987, computerized trading accelerated Black Monday. In 2008, derivatives and leverage nearly collapsed the banking system. In 2020, markets crashed in weeks because of global shutdowns. Every crash has a trigger, but every crash has a deeper cause: too much leverage and unrealistic expectations. Another key factor in this drop was valuation. Before the decline, many stocks were trading at historically high multiples. Investors were paying huge prices for future growth. When rates rise, those future profits become less valuable today. So prices had to adjust. This wasn't panic. This was repricing reality. Now, what happens after one of the biggest market drops in years? History gives us a few paths. Sometimes markets recover quickly. After 2020, stocks rebounded in months. Sometimes markets stagnate for years. Japan's stock market took decades to recover after 1990. Sometimes crashes lead to inflation. Governments print money to stabilize economies. This protects markets but destroys cash savings. Sometimes crashes lead to tighter regulation and slower growth. After 2008, banks faced heavy regulation. Credit slowed, growth changed. This time, the world faces unique challenges. Global debt is at record levels. Populations are aging. Geopolitics is more fragmented. Technology is transforming jobs and productivity. This means the recovery may look very different from past cycles. So what does this mean for normal people? Market drops affect everything: pensions, jobs, housing, consumer confidence. When markets fall, companies cut costs. Hiring slows. Investments shrink. But crashes also create opportunities. Every major crash in history created new winners. After 2000, tech giants emerged. After 2008, digital platforms dominated. After 2020, AI and automation accelerated. The key lesson is this: markets go up, markets go down, but systems evolve. The real risk is not volatility. The real risk is not understanding the system you're in. So when you hear that one of the biggest market drops in years just happened, don't just ask, how much did the market fall? Ask, what just changed underneath the system? Because the biggest crashes don't come from headlines. They come from shifts in money, debt, and power, and those shifts are happening right now. Extended deep dive continuation. Now let's go deeper into why this market drop matters more than most people think. Many investors believe market crashes are random events. But crashes usually happen when several hidden pressures build up at the same time. One of the biggest pressures today is liquidity. Liquidity is how easy it is to buy or sell assets without moving the price. During boom periods, liquidity feels infinite. Money flows everywhere. Everyone can sell at a good price. But during stress, liquidity disappears. When investors panic, everyone tries to sell at the same time. Buyers vanish. Prices fall rapidly, not because assets are worthless, but because no one is willing to buy. This is what makes crashes violent. Another hidden factor is leverage. Leverage means using borrowed money to invest. Hedge funds, banks, corporations, and even individuals use leverage to amplify returns. But leverage works both ways. When prices rise, gains are magnified. When prices fall, losses are magnified. If losses get too big, investors get margin calls. They are forced to sell assets to repay loans. Forced selling accelerates the crash. This creates a vicious cycle. Prices fall, margin calls. Forced selling, prices fall even more. This is why market drops often look sudden and extreme. Now let's talk about psychology. Markets are not just numbers. They are crowds of human emotions amplified by algorithms. When markets are rising, people feel safe. They believe growth is guaranteed. They take more risks. When markets fall, fear spreads instantly. People remember past crashes. They imagine worst-case scenario. This is a transition to a different financial environment. History shows that these transitions are painful. In the 1970s, inflation and oil shocks created a decade of volatility. In the 1990s, the internet transformed business models. In the 2000s, financialization and credit expansion reshaped economies. In the 2020s, AI, demographics, and geopolitics are rewriting the rules. Market drops often signal the end of an era and the beginning of a new one. So what should investors learn from this? First, diversification matters. Not all assets move the same way. Stocks, bonds, commodities, and real assets behave differently across cycles. Second, cash is not always trash. In high-rate environments, liquidity is power. It allows investors to buy when others are forced to sell. Third, long-term thinking beats panic. The worst decisions are usually made during extreme fear or extreme greed. Finally, understanding macro forces is more important than predicting headlines. Most people try to predict tomorrow's market move. The smartest investors try to understand the next decade, because the biggest gains are made by positioning early in structural shifts. This market drop may be remembered as just another correction, or it may be remembered as the first crack in a much larger transformation. We don't know yet. But one thing is certain. The financial system is changing faster than most people realize. And those who understand these shifts will not only survive market crashes, they will thrive in the new financial era. To truly understand what just happened, we need to look at how markets have reacted to major shocks in the past. Market crashes are not new. They are part of financial history. In 1929, the stock market crashed and triggered the Great Depression. At that time, margin debt was extremely high. People were borrowing money to buy stocks, believing prices could only go up. When the market turned, leverage destroyed portfolios and banks collapsed. In 1987, the market crashed in a single day, known as Black Monday. This time, the cause was early algorithmic trading and portfolio insurance strategies. When prices started falling, automated systems sold massive amounts of stocks, accelerating the collapse. In 2000, the dot-com bubble burst. Investors believed the internet would change everything, which was true. But they overvalued companies with no profits, no revenue, and sometimes no products. When reality hit, the Nasdaq lost nearly 80% of its value. In 2008, the global financial crisis was caused by excessive debt. complex derivatives, and housing speculation. Banks believed real estate could never fall nationwide. When it did, the entire financial system nearly collapsed. In 2020, markets crashed during the pandemic. But this time, central banks printed trillions of dollars to stabilize the system. It was the fastest recovery in history, but it also created massive inflation and asset bubbles. Every crash has a different trigger, but the pattern is similar. Too much optimism, too much leverage, a shock, a cascade of selling. Now look at today. Global debt is at record highs. According to the Institute of International Finance, total global debt surpassed $300 trillion, more than 3 times global GDP. Governments, corporations, and households are all more leveraged than in the past. Central banks raised interest rates at the fastest pace in decades. The US Federal Reserve, the ECB, and many others tightened policy to fight inflation. Higher rates mean higher debt servicing costs. This is a hidden time bomb. When debt becomes expensive, spending slows. Companies cut investments. Consumers reduce consumption. Governments face budget pressure. Markets are forward-looking. They don't wait for recessions to appear in the news. They react when they sense the economy is about to slow. Another factor is demographics. In many developed countries, populations are aging. Fewer workers support more retirees. This puts pressure on pensions, healthcare systems, and government finances. China, Europe, Japan, and even the United States are entering a demographic slowdown. This means lower growth potential in the long term. Lower growth means lower corporate profits. Lower profits mean lower stock valuations. This is why some investors believe future returns may be lower than in the past decades. But here's the twist. Technology is advancing faster than ever. Artificial intelligence, robotics, biotechnology, and energy transitions could create enormous productivity gains. If productivity rises faster than debt, economies can grow out of their problems. So the future is not guaranteed to be negative. It is a battle between debt, demographics, and technology. Now let's talk about what could happen next. Scenario 1, a soft landing. Inflation falls, interest rates stabilize. Economies slow but avoid recession. Markets recover and continue to grow, but at a slower pace. Scenario 2, a mild recession. Corporate profits decline. Unemployment rises slightly. Markets fall further but stabilize as central banks cut rates again. Scenario 3, a hard landing. Debt defaults increase. Banks tighten lending. Asset prices fall significantly. Governments intervene with stimulus and bailouts. Scenario 4, a structural reset. This is the most extreme. High debt leads to financial repression, currency devaluation, or major policy changes. We've seen this after World War II and in emerging market crises. No one knows which scenario will happen. But history tells us that the most dangerous moments come when people believe nothing can go wrong. This market drop is a reminder that risk never disappears. It only hides. For everyday investors, the lesson is simple. Don't assume the future will look like the last decade. Build strategies that survive multiple outcomes. Focus on assets with real utility and long-term demand. And always remember that volatility is the price of opportunity. Because every major crash in history created generational wealth for those who understood the cycle and stayed rational when everyone else panicked.